The 2008 financial crisis shocked the world. Lehman Brothers fell. The Federal Reserve opened emergency lending windows. Governments pumped billions into failing banks. Financial experts called it unprecedented. They were wrong. Every single response in 2008 followed a script written in December 1825. The Bank of England invented modern crisis management during a single terrifying week. The archives they preserved for generations prove it. Your economics textbook tells you modern central banking evolved gradually over centuries. It did not. The core playbook for saving a financial system from collapse emerged in a matter of days. A small group of men in London invented the emergency measures now deployed by every central bank on earth. They created this playbook while staring into total financial annihilation. The official story frames 1825 as one crisis among many, a footnote in the long history of British banking, a temporary disruption before the inevitable recovery. This framing obscures the truth. The 1825 panic was not about bad luck or poor judgment. It exposed structural failure in a system designed to concentrate wealth while distributing risk. The machinery of British finance had grown faster than anyone understood. Credit flowed through hundreds of small country banks with no coordination. Leverage multiplied beyond anything the financial gatekeepers tracked. When the pressure points cracked, the entire infrastructure of money threatened to vanish. The men who controlled the Bank of England held position at the bottleneck of British finance. Every note, every loan, every commercial transaction eventually flowed through their hands. Their emergency response did not emerge from economic theory. It emerged from the raw incentive to survive. They engineered a rescue operation in real time. In doing so, they made themselves untouchable. Welcome to Rashi Historical. Behind every headline in your history book, there's a ledger they kept hidden. We open it. The Bank of England's decisions in December 1825 still control your life today. When the Federal Reserve announced emergency lending facilities in 2008, officials followed protocols invented during the 1825 panic. When the European Central Bank flooded markets with liquidity in 2012, they used the same logic. When your government guarantees bank deposits, it applies principles first tested on the streets of London nearly 2 centuries ago. You live inside a financial system built to prevent the catastrophe of 1825 from happening again. Every central bank on earth maintains emergency powers designed to replicate what the Bank of England did during those desperate December days. Understanding 1825 means understanding why your money works the way it does. The Bank of England archives contain the original meeting minutes from the crisis. They document the panic, the debates, and the improvised solutions. These records show the exact moment central banking transformed from passive money management into active crisis intervention. This is the story of how Britain nearly lost everything, and how the scramble to survive created the financial architecture you now take for granted. The crisis arrived without warning. Or rather, the warnings existed, but nobody with the authority to act chose to listen. The Bank of England's Court of Directors had watched speculation grow for 3 years. They debated intervention. They discussed raising rates. They considered restricting credit. In the end, they hesitated. Their hesitation nearly destroyed British finance. The sequence of collapse began in the provinces. Small banks in market towns across England faced sudden demands for gold. Depositors who had trusted these institutions for years arrived at bank doors demanding their money. The banks lacked reserves to pay. One by one, they closed. The closures accelerated. 40 banks failed in a single week of late November 1825. By early December, the number exceeded 60. Some counts placed the total above 70. Each failure triggered runs on neighboring institutions. The contagion spread faster than anyone anticipated. London banks watched the provincial collapse with growing horror. They knew the infection would reach them. Country banks held accounts at London correspondent banks. When country banks failed, they defaulted on those accounts. The losses cascaded upward through the system. December 12, 1825, marked the point of maximum danger. Pole, Thornton and Company, a major London bank serving 47 country banks as correspondent, closed its doors. The failure of Pole Thornton proved the crisis had reached the heart of British finance. This was not a distant problem affecting rural farmers and provincial merchants. This was a systemic threat to the City of London itself. The next 72 hours determined whether Britain would retain a functioning financial system. Understanding the collapse requires understanding what preceded it. Britain in the early 1820s experienced something new. The end of the Napoleonic Wars brought peace after 2 decades of continuous conflict. Trade routes reopened. Capital flooded back into private hands. Investors began searching for returns. The problem was straightforward. British government bonds, the traditional safe investment, now paid miserable interest rates. The national debt had ballooned during the wars. Peace allowed the government to refinance at lower rates. Bondholders watched their income shrink year after year. Money began searching for alternatives. Latin America provided the answer investors sought. The Spanish Empire was collapsing across South America. New republics emerged in Mexico, Colombia, Peru, Chile, and Argentina. These new nations needed capital. They needed roads, mines, ports, and armies. European investors, especially British investors, rushed to provide it. Between 1822 and 1825, London became the center of Latin American finance. New companies formed to exploit silver mines in Mexico. Others promised to develop gold deposits in Colombia. Some planned to build canals across Central America. Investment prospectuses circulated through London coffee houses and gentlemen's clubs. Stock prices climbed month after month. The numbers reached staggering proportions. Thomas Joplin, a contemporary financial writer, documented the mania in real time. Foreign loan issues on the London market totaled nearly £40 million between 1822 and 1825. For context, the entire annual government budget ran around £55 million. Private investors poured the equivalent of a full year's government spending into speculative foreign ventures. The mining stocks performed even more spectacularly. The Anglo-Mexican Mining Company saw its shares rise from £33 to £158. The Real Del Monte Company watched its stock climb from £70 to £1,350. Investors who bought early saw returns of 500%, 1,000%, or more. Success bred imitation. New companies formed weekly. Some had legitimate business plans backed by genuine expertise. Others existed only on paper. A few were outright frauds with no assets, no operations, and no intention of ever conducting business. The prospectuses promised impossible returns from mines nobody had surveyed in countries most investors would never visit. Credit expansion fueled the boom. Country banks across England issued their own notes. These small regional banks operated with minimal reserves and limited oversight. They lent aggressively against the collateral of rising stock prices. Each new loan created new purchasing power. Each purchase pushed prices higher. Each price increase justified more lending. The flow of credit became self-reinforcing. A merchant in Manchester would borrow from his local country bank to invest in mining shares. The rising value of those shares would serve as collateral for additional borrowing. The additional borrowing would fund additional purchases. The cycle continued until the merchant held a portfolio worth tens of thousands of pounds, all financed by debt. The country banks themselves borrowed from London correspondents. They rediscounted their commercial paper at the Bank of England. They drew on credit lines they had never tested under stress. The entire provincial banking system operated on the assumption prices would continue rising. The Bank of England's Court of Directors observed this expansion with mounting concern. Their meeting minutes from 1824 and early 1825 record debates about the dangers of speculation. Some directors argued for raising the discount rate to slow credit growth. Others warned about restricting commerce during an economic boom. The court chose caution. They made minor adjustments. They issued quiet warnings. They took no decisive action. The bank faced a structural problem beyond the immediate speculation. It held a monopoly on joint stock banking in England, meaning no other large bank with multiple shareholders operated within the country. Yet hundreds of small private banks and country banks functioned outside its direct control. These smaller institutions issued their own notes. They extended their own credit. The Bank of England influenced them indirectly through its discount rate and its willingness to redeem country banknotes. Direct control proved impossible. The extraction of British capital continued throughout 1824 and into 1825. British investors sent gold and credit instruments to Latin America. They received paper shares and bond certificates in return. The hard assets left. Paper promises arrived. Contemporary observers noted the troubling dynamics. Much of the money leaving Britain would never return as productive investment. The Latin American mines produced little metal. The bonds funded governments with uncertain futures and shakier finances. The infrastructure projects existed primarily as artistic renderings and promotional materials. For 3 years, none of this mattered to investors. Prices rose, paper profits accumulated. The machinery of speculation churned forward. The concentration of risk built invisibly. And the collapse, when it arrived, proved all the more devastating for having been so long delayed. The crisis emerged slowly before accelerating beyond control. By mid-1825, the first cracks appeared in Latin American investments. Mining companies reported disappointing operational results. The silver deposits in Mexico proved harder to extract than promoters had promised. The gold in Colombia remained in the ground. Operating costs consumed the capital investors had provided. Stock prices began falling in the summer months. The decline started gradually, a few percent one week, a few percent the next. Investors who had borrowed to buy stocks faced margin calls from their lenders. They sold shares to meet their obligations. Their selling pushed prices lower. Lower prices triggered additional margin calls. The downward spiral began. The extraction of capital reversed direction. Money that had flowed into speculative investments now flowed out. Investors converted their holdings to cash. They deposited the cash in banks, or they demanded gold. Gold became the critical pressure point. The British monetary system rested on the gold standard. Every banknote, in theory, was convertible to gold coin on demand. The Bank of England maintained reserves to honor this commitment. Country banks maintained smaller reserves, or relied on their ability to obtain gold from London correspondents. The entire system depended on the belief conversions would remain rare. When conversions stopped being rare, the system cracked. Country banks faced the first wave of withdrawals. Depositors in rural England watched the London stock prices fall. They read newspaper reports of losses. They worried about their local banks. They withdrew their savings. They demanded gold or Bank of England notes, the only currency they trusted, without reservation. The country banks lacked reserves to meet these demands. They had lent aggressively during the boom years. Their assets consisted of loans to farmers, merchants, and speculators. These loans would repay over months or years. The withdrawal requests came immediately and demanded immediate satisfaction. Banking runs spread through the English countryside like fire through dry timber. Customers lined up at bank doors before opening. Some banks paid out until their reserves vanished entirely. Others closed their doors and refused all withdrawals. News of each closure triggered runs on neighboring banks. The infrastructure of provincial credit began disintegrating. The Bank of England records document the accelerating panic in precise detail. In late November 1825, country banks began failing in clusters. The Court of Directors received reports of closures from across England: Birmingham, Manchester, Bristol, Norwich. The geography of failure spread. Each failure rippled outward through commercial networks. Merchants who held accounts at failed banks lost their working capital overnight. They could not pay suppliers who had extended credit. Suppliers could not pay manufacturers who had provided goods. Manufacturers could not pay workers who had provided labor. The entire commercial infrastructure of provincial England began seizing up. The concentration of failures created geographic dead zones. Entire regions lost their banking services completely. Farmers could not sell grain because no bank would provide letters of credit. Manufacturers could not ship goods because no bank would guarantee payment. The flow of commerce ground toward a halt. London banks faced their own reckoning. Country banks held accounts at London correspondent banks. These relationships provided country banks access to the national payment system. When country banks failed or suspended payments, they defaulted on their London accounts. The correspondent banks absorbed the losses. Pohl, Thornton and Company illustrated the cascade with brutal clarity. This firm served as London correspondent to 47 country banks across England. Their business model depended on the stability of their country bank partners. When those partners failed or suspended payments, Pohl Thornton faced an avalanche of unexpected losses. The partners of Pohl Thornton attempted to find support. They approached other London banks for emergency loans. They sought assistance from the Bank of England. The numbers proved insurmountable. On December 12, 1825, Pohl, Thornton and Company closed its doors and suspended all payments. The Pohl-Thornton failure electrified the city of London. Every banker understood the implications. This was not a small country bank in a distant market town. This was a major London institution with connections throughout the financial system. Its failure meant the crisis had reached the heart of British finance. The next few days brought chaos to Threadneedle Street and Lombard Street. Banks across London faced runs from frightened depositors. The stock exchange suspended trading in bank shares. The discount market, where banks traded short-term commercial paper, froze solid. Commercial credit evaporated. Businesses with perfectly sound operations and reliable customers could not borrow to meet payroll. The bottleneck tightened. Every banker, every merchant, every creditor in London looked to the Bank of England. The question was simple. Would the bank save the system, or would it let the system collapse? The Bank of England's response to the December 1825 crisis established the template for all modern central bank interventions. The Court of Directors met in continuous session day and night as reports of failures arrived. Their decisions during those frantic days created precedents, still followed by central banks worldwide. The first critical choice involved the discount window. Banks and merchants normally brought commercial paper to the Bank of England for discounting. The bank would purchase bills of exchange at a discount to face value, providing immediate cash in exchange for the right to collect the full amount later. This practice provided routine liquidity to the financial system during normal times. During the crisis, demand for discounting exploded beyond all precedent. Banks facing runs brought every eligible piece of paper they held. Merchants who could not obtain credit from their banks came directly to the Bank of England. The queue of desperate borrowers stretched through the building and into the street. The Court of Directors faced a choice with no good options. They could ration access to the discount window, preserving the bank's reserves but allowing the panic to spread unchecked. Or they could lend freely, providing liquidity to anyone with acceptable collateral but risking the bank's own solvency. They chose to lend. The Bank of England's discount operations in December 1825 dwarfed anything in previous history. The bank discounted more paper in a single week than it normally handled in a month. The gatekeepers of British finance threw open the gates. The bank's records show the operational intensity of those days. Clerks worked through the night processing applications. Directors approved loans in batches, rather than individually reviewing each request. The normal procedures for evaluating creditworthiness gave way to emergency protocols. Anyone with collateral received cash. Jeremiah Harman, a bank director who later testified before Parliament, described the approach directly. The bank lent, he said, by every possible means and in modes we had never adopted before. They accepted securities as collateral we should not have looked at in ordinary times. The emergency justified measures violating every standard of normal prudence. But the reserves dwindled with terrifying speed. Each loan paid out in gold or Bank of England notes. The bank's bullion holdings, the foundation of the entire monetary system, fell toward dangerous levels. Some estimates suggest the bank came within hours of suspending gold payments entirely. Such a suspension would have meant the end of the gold standard and the collapse of the pound sterling. At this moment of maximum danger, bank officials made a discovery. Deep in the vaults at Threadneedle Street, workers found a cache of old £1 notes. These notes had been printed years earlier for a planned issue and then stored when plans changed. They had never entered circulation. They remained valid currency. The bank rushed these forgotten notes into circulation immediately. The £1 notes provided emergency liquidity at the precise moment the system needed it most. Small denomination currency allowed banks to pay depositors in notes rather than gold. This preserved the bank's diminishing bullion reserves while still meeting withdrawal demands. The significance of this discovery went beyond the immediate crisis. It demonstrated the importance of maintaining reserves beyond what normal operations required. The old notes, forgotten in a vault, saved the monetary system. Every central bank since has maintained emergency reserves for situations beyond normal planning. The crisis response extended beyond the discount window. The bank coordinated directly with the government throughout the emergency. The Chancellor of the Exchequer authorized extraordinary measures and provided political backing for the bank's decisions. Treasury officials attended bank meetings. The partnership between fiscal and monetary authorities during crisis, now standard practice worldwide, began in the desperate consultations of December 1825. Communication proved equally important. The bank let word spread through the financial community of its intentions. Bankers and merchants learned the bank would support solvent institutions facing temporary liquidity problems. This communication itself calmed markets. The incentive to panic diminished when participants believed rescue remained possible. The combination of lending, coordination, and communication gradually stabilized the situation. By late December, the acute phase of the crisis had passed. Banks still failed. Commercial losses accumulated. The damage to the provincial economy would take years to repair, but the systemic collapse had been averted. The financial infrastructure of Britain survived. The bank's bullion reserves reached their absolute low point on December 24, 1825. According to contemporary accounts, reserves fell below £1.5 million. Normal operations required reserves of 8 to 10 million. The bank had expended more than 80% of its holdings to save the system. The recovery proceeded slowly through the first months of 1826. January and February saw continued bank failures, but no new runs on surviving banks. Confidence rebuilt gradually. Deposits returned. The money supply stabilized. Commercial credit resumed flowing. The Bank of England had invented the playbook for modern crisis management. Lend freely against good collateral. Accept unusual securities during emergencies. Coordinate with fiscal authorities. Communicate intentions to calm markets. These 4 principles would guide central bank responses for the next 2 centuries. The 1825 crisis reshaped British financial regulation and established patterns persisting to this day. Parliament launched investigations into the causes and responses. The 1832 Select Committee on the Bank of England examined the institution, its conduct, and its monopoly position in British banking. Thomas Joplin and other financial writers published analyses identifying the structural weaknesses the crisis had exposed. 3 major regulatory changes followed directly from the crisis. The Country Bankers Act of 1826 legalized joint stock banking beyond a 65-mile radius of London. Before this reform, the Bank of England's charter prohibited any other joint stock bank from operating in England. Small private banks with limited capital were the only alternatives. Legislators concluded these undercapitalized institutions had been the weak point in the system. Larger banks with more shareholders and more capital would prove more stable during future panics. The Bank of England established branches outside London for the first time in its history. Before 1825, the bank operated only from its Threadneedle Street headquarters. After the crisis, it opened offices in major provincial cities across England. These branches provided direct access to Bank of England credit for regional businesses and banks. The centralization of emergency lending authority required decentralization of operational presence. Small denomination private banknotes faced gradual elimination. The circulation of £1 and £2 notes by country banks had contributed to the credit expansion and the subsequent collapse. Legislation phased out these notes over following years, reserving small denomination currency for the Bank of England alone. Private banks retained the right to issue larger notes but lost the ability to flood the economy with easily printed small currency. These reforms addressed symptoms rather than causes. The underlying pattern of speculative boom, credit expansion, and eventual collapse would repeat with dreary regularity. The 1830s saw new waves of speculation in American securities. The 1840s brought the railway mania. The 1850s, 1860s, and 1870s each produced their own crises. The pattern proved inescapable, but the response template held firm. Each subsequent crisis saw the Bank of England implement emergency lending. Each saw coordination between monetary and fiscal authorities. Each saw communication designed to calm panicking markets. The 1825 playbook became the permanent playbook. The academic study of financial crises eventually formalized these lessons. Walter Bagehot's 1873 book, Lombard Street, articulated what later became known as the lender of last resort doctrine. Bagehot wrote, "The central bank should lend freely during panics, at a penalty rate, against good collateral." This formulation became the standard prescription for crisis management taught in every economics program. Bagehot did not invent this doctrine. He described what the Bank of England had already been doing since 1825. The practice preceded the theory by nearly 50 years. Jeremiah Harman's 1832 testimony before Parliament contained the essential elements. Bagehot provided elegant articulation of principles already proven in practice. The 2008 financial crisis demonstrated the enduring relevance of 1825 with startling clarity. When Lehman Brothers collapsed in September 2008, the Federal Reserve faced the same choice the Bank of England confronted in December 1825. Restrict lending and preserve institutional resources, or lend freely and risk running out of ammunition. The Fed chose to lend. Its emergency facilities provided trillions of dollars in liquidity to banks, money market funds, and commercial paper markets. The Fed accepted collateral it would have rejected during normal operations. It coordinated with the Treasury Department at every step. It communicated its intentions through public statements and private reassurances. Every element of the 2008 response replicated 1825. The mechanisms differed enormously. The scale dwarfed anything the Bank of England directors imagined. But the logic remained identical. When the financial system faces collapse, the central bank becomes the lender of last resort. Nothing else matters. The European sovereign debt crisis of 2010 through 2012 provided another demonstration. When bond markets rejected Greek, Portuguese, and Spanish government debt, the European Central Bank intervened. It purchased government bonds directly. It provided unlimited liquidity to European banks. It communicated its commitment to preserve the euro at all costs. Mario Draghi's famous 2012 statement promising the ECB would do whatever it takes echoed Jeremiah Harman's testimony from 180 years earlier. Central bankers facing crisis abandon normal procedures. They lend by every possible means. They accept collateral they would never examine during ordinary times. The emergency justifies everything. Your life today exists within this framework. The Federal Reserve, the European Central Bank, the Bank of Japan, the Bank of England itself, all maintain emergency lending powers. All hold reserves they expect never to use under normal circumstances. All stand ready to flood financial markets with liquidity if panic strikes. The deposit insurance protecting your bank account derives from the 1825 realization bank runs destroy solvent institutions. The capital requirements imposed on your bank derive from the recognition undercapitalized lenders amplify crises. The stress tests regulators conduct derive from the understanding latent vulnerabilities must be identified before emergencies occur. The entire architecture of financial regulation reflects lessons paid for in the suffering of 1825. The parallels extend beyond crisis response into the structure of booms. The 1825 speculation featured financial innovation regulators did not understand. Country banknotes and Latin American mining stocks were the complex derivatives of their era. They allowed leverage to build beyond what any central authority monitored. They created conditions for catastrophic unwinding. The 2008 boom featured mortgage-backed securities, collateralized debt obligations, and credit default swaps. These instruments allowed leverage to build beyond what any regulator tracked. They created conditions for catastrophic unwinding. The instruments changed. The pattern did not. The incentives driving these cycles remain unchanged across 2 centuries. During good times, financial innovation generates profits for those who adopt it early. Regulators lack the knowledge or authority to restrain practices they do not fully understand. Leverage builds steadily, risks concentrate in unexpected places. Then the cycle turns, and the emergency measures, invented in 1825, get deployed once again. Your children will experience another crisis built on these same foundations. Your grandchildren will experience another after it. New instruments will appear, too clever for regulators to comprehend. New leverage will accumulate, hidden in the complexity. New concentrations will form in corners of the system nobody watches carefully. When the collapse arrives, central banks will respond with the same measures invented in December 1825. They will lend freely. They will accept unusual collateral. They will coordinate with governments. They will communicate to calm markets. The playbook will work, or it will not. If it works, confidence will return and the cycle will begin again. If it fails, something worse will follow. The Bank of England archives remain available to researchers. The Court of Directors' minute books record the debates and decisions of those desperate December days. The discount ledgers show the emergency lending volumes. The correspondence files preserve the appeals from failing banks and the responses from bank officials. These documents prove the modern financial safety net was not designed by economists in comfortable university offices. It was improvised by bankers staring into the abyss of destruction. The theory came decades later. The practice came first, in a London winter nearly 200 years ago. You live inside the system those panicked men created. Every time you swipe a card, deposit a check, or take out a loan, you rely on emergency mechanisms invented during the 1825 crisis. The central bank standing behind your bank exists because Jeremiah Harman and his colleagues understood solvent institutions must not be allowed to fail during panics. The deposit guarantees protecting your savings exist because provincial English depositors lost everything when their country banks closed. The 1825 crisis did not end. It became permanent infrastructure. The emergency response became the normal operating assumption of global finance. You take for granted a world where central banks rescue failing systems. This world did not exist before December 1825. It has existed ever since. The archives prove it. The ledgers confirm it. The money trail leads back 200 years to a group of frightened men in London who invented modern finance while trying to save themselves. They succeeded. We still live in their creation. And when the next crisis arrives, we will use their methods once again. The night they almost lost everything became the template for saving everything, forever.